Well, as promised, we have a special guest who joins in now on the show. We have Mahesh Nandurkar of CLSA who joins in from the sidelines of the CLSA 18th India Forum, where more than 75 companies and over 175 investors will be exchanging their views and speaking at this conference. Mahesh, hi, good afternoon and thanks for joining in. I wanted to know what the response is so far to the conference and how is the mood towards India now?
Hi, good afternoon to you and to your viewers. Well, the response from the investors, continue to be, quite positive, especially because, India clearly stands out relative to the other emerging markets in terms of various macro parameters, such as, the current account deficit is, now down significantly, and now it's less than the FDI. The fiscal deficit is not an issue anymore, and while there are several other global economies which are struggling to revive inflation, India seems to be situated, in a very, sweet spot at about, at around 5% kind of an inflation. So while there is, some sense of disappointment as far as the corporate earnings go, and there is, an investor concern that while all the macro parameters look quite all right, why isn't that translating into better corporate performances yet? But I still get a feeling that investors are, willing to take a more longer-term bet and are willing to wait for the corporate earnings recovery to happen.
Mahesh, hi, good afternoon. CLSA was among the most bullish, in terms of the whole Modi premium on India till about one and a half year back. Do you think that optimism was a bit misplaced, given the way we have seen the kind of market reaction, the kind of earnings that we have seen over the last 12 months or so? Would you say that in hindsight maybe that optimism was misplaced, or would you still continue with that optimism?
No, I think as far as the government actions are concerned, I think the actions are still, aimed, at, improving trend going forward. We are clearly seeing, several, incremental positive steps from the government side. I think probably, one of the reasons why the markets and the investors, overestimated, the pace of earnings recovery was that, while the macro was running good, I think the market underestimated the impact of disinflation. Now, while disinflation is something that, all of us like, especially coming down from 10% CPI down towards 4 to 5% level, but I think somewhere, the market misread the impact, the negative impact that a disinflationary environment has on growth. And I think that has manifested itself into weaker rural wage growth, weaker rural demand growth. I believe that the investors and the market to some extent still haven't fully appreciated the fact that the property markets are also going through a phase of a slowdown, which can be partially attributable to the low inflation once again. Also, the nominal GDP growth rate, which was at 14% or so 2 years ago, now it's down to about 8 to 9%. So while the real GDP growth rate remains unchanged, the nominal numbers have come down, and we as analysts and investors focus on corporate performance in nominal terms and not on real terms. So I think all these factors put together, I would say that the reason why a good macro is not translating into a better micro or corporate performance is the disinflationary environment, where I think the market underestimated the impact of.
Okay, that's a fair point. But what do you see as the returns from this market over the next 1 year? Because this year has done, the market has done nothing. In fact, it's down 5.5%. From this level of 25,800 on the Sensex, what kind of realistic returns would you expect over the next 12 months?
I think over the next 12 months, I wouldn't expect a supernormal return. I would expect returns in line with cost of equity, which would be about 12 to 13%. But I think, the year after that could be much better because, by that time, we would be, witnessing the full-fledged capex recovery. And, to that extent, the corporate earnings growth would also be, much faster than what it is now or what it will be over the next 12 months or so. So my sense is that it's reasonable to expect over the next 2 years about 30% market return. But yeah, the next 1 year, I would say maybe 12 to 13%.
Okay, Mahesh, one of your top picks is Infosys. Are you surprised by the way that stock has started to underperform so much over the last few days?
Anuj, I'm sorry, I'll not be able to comment on specific stocks.
Okay.
But yes, we continue to like IT sector, in general, and that remains one of our, top, top overweight sector.
Okay,
And the reason behind that is, like clearly we are expecting, some sort of a recovery from, the US, and, that should be, a positive news for the discretionary expenditure and therefore the IT services, sector in general, and also the fact that the stronger dollar will help the reported numbers in rupee terms as well.
Okay, that point is taken. What about the pharma sector, Mahesh? Because till about 3 months back, nothing could go wrong there, and now all of a sudden we have seen big cracks opening up in some of the large cap names. What's your call there?
Yeah, you're right, and we are seeing heightened element of regulatory risk, in various pharma sector names. And clearly that is more attributable to the adverse commentary coming in from the US FDA. So I believe that this factor has driven the beta for the sector up, and so to that extent the sector has gotten derated. But I still believe that there are some good quality names, good quality managements in that sector, and the recent correction or the recent underperformance in some of these names I believe is a good time to accumulate.
So where do you see the leadership coming from, Mahesh? You did mention that you expect a 30% market return over the next 2 years. Sectorally, who could be the leaders of this market?
See, the thing is, if you take a 2-year view or a 3-year view, the biggest story in India has to be, in the form of capex cycle recovery. So while that is not visible as yet, and our house view has been that the capex cycle recovery will be slow, and that's the reason why I said that in the next 6 to 12 months I don't expect a supernormal return. But if I take a 2-year view, the story has to be capex driven, and from that point of view, the sectors that should do better over a 2-year period will be the ones that are linked to the investment cycle. So those include the financial sector, especially the banks, and the non-banking institutions which are linked to the corporate sector recovery, and not necessarily the retail side. The other sectors would be capital goods, cement, to some extent even property. So I would say these are the 4 sectors that should lead market returns over a 2-year period.
Mahesh, I know you won't look at the day-to-day market movements, but the last 2 or 3 months have been particularly disappointing, right? I mean, we've started to see a lot of underperformance compared to emerging markets. In the first half, it was still okay, but now we have seen, even today, for example, we have seen quite a bit of underperformance, and the FI outflow is only increasing. What do you think is the main reason for that? Is it India-specific problem now, or is it just emerging market problem, and within that, maybe India stands out now?
Yeah, so FII flow clearly has to be more a global factor, and there is clearly an emerging market factor as well. And as over the last few weeks, the economic data from the US seems to be pointing towards a higher and higher probability of a rate hike later in the year, so which has impacted the emerging markets in general. Specifically, within India, what we have seen is the pace of earnings downgrade continues to be quite high. Also, there have been these recent political developments, especially the Bihar state election, which was kind of a setback for market sentiment. So as a combination of general defensiveness from the FIS towards the emerging markets in general, and these couple of specific factors pertaining to India, has been the cause of underperformance. And I believe that going forward over the next 6 months, there are not that many macro triggers for the Indian markets, apart from the fact that if we get to see, let's say, the GST progress in the upcoming session of the Parliament, or if we see some big positive surprise coming in the budget, I don't really see too many positive triggers in the next 3 to 6 months.
Okay. You did mention a while back that financials like banks and some NBFCs could also be, one of the key drivers in the next couple of years. But within banks, where do you think the highest beta could come through? Is it still with private sector banks, or now, given that the government is, executing some reforms on the PSU banking front as well, is this a good time to be increasing allocation to the PSU banking space, the bigger ones?
So within the banking space, as I said, we believe that the corporate-oriented banks, should do better, as a general class. And, in the corporate sector banks, in the private corporate sector banks, we have, seen corrections, recently, and some of the valuations have come down to a more to a more moderate level. So I would say that a combination of these relatively cheaper private sector banks, which have getting towards the corporate sector recovery, and maybe some large public sector banks, could be a combination. But I would still go more in favor of private sector banks at this point in time.
Mahesh, are you disappointed by the action in the finance ministry in particular? We've seen disinvestment targets being missed. That's being made up by piecemeal attempts like excise duty hikes, the cess on various services and all. Do you think that is one area where maybe we have missed the bus and that could be hurting the sentiment?
No, I think, I would actually say the other way around, that, the fear among the investor community was that, after the recent loss of elections in Bihar, the government might actually become more populist and become, more sort of, consumption expenditure friendly. So that has actually been, the investor concerns. But, some of these steps that you mentioned, the fact that the taxes on auto fuels have been raised, and the tax on services have been raised, but those incremental tax collections, the government officials have clearly said, would be going towards infrastructure construction and some of the social sector infrastructure construction, which I think is actually a good news, not just because it is giving a fillip to the construction sector and to the capex cycle in turn, but also it sends out a very strong message that the government is pretty much focused, on what needs to be done. Also, the government clearly seems to be, focused on, is not afraid of taking some unpopular decisions.
That point is taken.
That raising auto fuel taxes. Yeah,
that point is taken, Mahesh. But the counter argument is that did we miss the chance to increase consumption or have a bit of a consumption boom, taking advantage of the lower commodity prices, which in turn would have led to a pickup in growth, which really remains the biggest problem right now.
No, see, ultimately, when the oil prices come down from $100 to $50, and since India imports about 1 billion barrels of oil, the cumulative saving for the economy as a whole is about $50 billion. Now, whether you want to spend that on consumption or whether you want to spend that on investments is a choice that the government needs to make. And I would actually say that, if we have to look at a more sustainable and more longer-term growth, I think the better way of utilizing that saving is to channelize it towards infrastructure spending and capex, because that will ultimately lead to job creation, that will ultimately lead to consumption expenditure as well. So I would say that what Indian economy needs today is not more of a consumption boom, but more of an investment boom. So I'm actually quite happy that large part of the oil price saving is going towards investments and not towards consumption straight away.
Okay. In the broader markets, we are seeing many sectors that are now seeing perhaps just a trading bounce, but interest nevertheless, whether it's aviation with the Indigo IPO, whether it's the sugar space, whether it's some of these defense stocks, any sunrise sector or any interesting smaller sector where you see a potential or value in the next 6 to 12 months?
So, within the mid-cap space, I think the segment where we are clearly seeing more action, is towards the road sector, and there are a whole bunch of mid-caps, operating in that segment. So that segment clearly looks interesting to us. Within the other sectors, I would say the urban discretionary consumption looks interesting, especially on the entertainment side, where we are seeing some signs of discretionary consumption looking up in certain segments. So the entertainment industry, from that point of view, looks interesting. So I would say those are the two sort of relatively smaller sectors that look appealing.
Okay, Mahesh, final question then. In the near term, should we expect this sideways movement to continue for the market, and would it continue to remain a bottom-up stock picking market, or do you think over the next 3 or 6 months there's a chance that maybe the market will try to break out of this range that we have seen over the last 6 months or so?
Yeah, so as I said, over the next 3 months, the macro event that we're looking at is, one is the progress on GST bill, and secondly, the budget, which will most likely, we will see, greater clarity and the roadmap on the corporate income tax rate being cut. So these are really the two macro events. But aside from that, I don't really see any big positive trigger on the macro side. So to that extent, yes, I mean, I would say that the market, should continue to remain sideways in the near term. And the focus would be, on the bottom-up ideas, especially, the December quarter results and the March quarter results, where I think the low base of last year will begin to show up in the corporate numbers, and the YOY comparisons will be looking better, and you will see much better corporate performance in December and March quarter. So yes, I mean, I would say that it's better to be looking at bottom-up stock ideas and where you have the earnings visibility, especially in the near term.
All right, Mahesh, thank you.